Okay, we're going to go ahead and get started. Hopefully everybody can hear me. If you can hear me, just type a Y into the chat box, please. Okay, sounds good. Okay, let's get started then. All right, so obviously the name of today's class is Order Flow, Back to the Basics. I'm going to start by introducing Peter. He's going to be the presenter today. And then he will take over and tell you guys all about Jigsaw trading and using his trading tools. Peter Davies started trading years ago. Disillusioned with advisors' results, he managed his own portfolio. Discovering a passion for day trading, he struggled with many sources of data. So Peter developed tools that organized order flow information much more logically. Those tools are now the #1 ranked trading software as reviewed by Investimonials. Peter is currently running Jigsaw Trading and will be talking about some of the uses and features his software offers. Many of you are familiar with our Zaner 360 platform. It's a futures and option platform that is available for free to DeCarley trading brokerage clients. And it is compatible with the Jigsaw tool that will be featured in today's class. Welcome, Peter. It's a pleasure to have you, and it's all yours.
Thank you, Carly. Thanks for that, and thanks everybody for attending. First, we have to just quickly look at the disclaimer. One of the things in this mandatory disclaimer that's probably not covered that should be is risk. So whenever anybody talks about trading, they can really only talk about it from their perspective, and part of that perspective involves their appetite for risk. So just bear that in mind today, that this does involve my own risk appetite when I talk about trading. So whenever you hear somebody talk about trading, make sure you need to kind of tune that to your own risk appetite. 1 second. Right, so those of you that know Jigsaw, or maybe took a peek at our website before this webinar, you'll know that we sell a set of tools for reading order flow. And those tools look at both short-term order flow as well as historical order flow. And they run on the Zaner 360 platform, as Carly said. But that's not really the focus of the discussion today. Or rather, the focus isn't going to be any particular set of tools. So what we're going to look at is the theme or the theory or the concept or the principles behind all order flow tools. So our objective is to remove any remaining confusion about the theory of order flow so that you understand clearly, what order flow is, why it's relevant, and how it can be applied. Now, we have done this before, but it's been a few years since we did this, and I think it's worth, circling back to this, back to basics, so that, people don't overcomplicate things when it comes to reading order flow. So we can see, in the past few years, everybody's talking about HFT, and everybody's talking about, how complex order flow is, and I think we need to kind of bring it back down to earth and simplify it a bit. Now, why do we do this? Well, I've come across a lot of people that use one order flow tool, but they've got no clue how to use other order flow tools. So a good example would be somebody that trades, say, a cumulative delta divergence, and they're trading that mechanically, but then they look at a footprint chart and they've got absolutely no idea what to do. And that's because they don't fully understand the underlying theory behind the tools. So that use of cumulative delta is really quite superficial. It's done on the basis of using a pattern, somebody told them to use, not on the basis of understanding what it's really telling you about market participation. So when those divergences don't work because of changes in participation levels, a lot of the traders that use that tool are lost. So it's kind of like they're reading the words, but they're not really understanding the story. Now, with order flow, the 80-20 rule very much applies, and that means that 80% of the benefit comes from 20% of the knowledge, or 80% of the effects come from 20% of the causes. So you could build encyclopedic knowledge of order flow, but it's still mastering the basics that is going to yield the greatest benefits. So if you've got a head full of order flow concepts and you think you need to keep 1,000 rules in your head to use it, then kind of consider this to be a bit of a spring clean. Because the bottom line is that all order flow tools are simply a different view of the same information for the same reason. And after teaching literally thousands of traders these concepts and seeing the results, It's my belief that understanding the theory behind these tools is going to make the use of the tools much more productive. So at the end of this session, you should understand the mechanics of price change and be able to interpret any order flow tool. Now that doesn't mean you'll be able to use any order flow tool immediately, because these tools are a bit like riding a bike. It takes a little bit of practice, but conceptually you should be able to assess any order flow tool, the pros and the cons, the perspective of that tool. And finally, we're going to give you some actionable information that you can take away and start using in your trading. And obviously you're going to need to practice a little bit, dip your toe in the water, when you start to use order flow before, just getting too excited and going all in. Now, obviously we need to know really what is the benefit of using order flow. So I imagine we've all faced this conundrum. We've got a price here, a price level here that we're looking to enter a trade. It's an area we want to do business. Market could reverse there, it could fall short, it could poke through the level and then reverse, or it could just blow straight through. So what do we actually do? And we could, put in an order before the level and then have a really wide stop which allows it to poke through and turn. You could also scale into a trade there. But both of those are effectively ways to accept a lack of precision on your entry price. And you don't actually need to accept that lack of precision. So, why not just say, okay, I want to be more precise. And using order flow, you have information to help identify if and when a move is occurring and then trade it when you have that confirmation. And the goal is to avoid trades that are going to just run immediately straight against you and refine your entry on the good trades. And that goal is something that you can actually achieve. Now, we can also use order flow to set bias, which is something I very strongly believe in. Most markets like the S&P 500 crude, they're going to put in good runs to the upside and the downside on most days. And that's just a side effect of speculative trading. So, people that buy short term, they're not so much buyers, they're actually future sellers. So on a speculator driven day, which is most days, I would say today probably wasn't driven by short-term speculation. We get to a point where those that bought need to unwind by selling, and that activity itself initiates a move to the downside. Then the short-term speculators jump on that short-term momentum to the downside until they need to unwind their shorts by buying, and then we start moving up. So order flow helps you recognize the transitions between that, switch from the buy side to the sell side to the buy side that we see intraday. And again, helps you see that just to help you stay on the right side of the market. Doesn't mean you have to necessarily buy the low of the day or be selling the high of the day. You can take a step back and watch those transitions take place, set your bias, and then take your trade. And the trade in that case would be something called a second entry, and that's a key element to the way I trade. So, I'm like most people. I come into the market in the day, I do my prep, and I've got price points I use to identify where what I call a major reversal might take place. A major reversal would be, reversing an intraday trend. But most of the time I don't enter a trade there. So I'll let the market reverse, let the order flow confirm that was really reversal, and then I look for something I like to call a second entry or a pullback. And we know that markets stair-step. We get these hidden backstops created once a move is underway. These are things that may or may not be visible on the chart. We're going to show you later how those are visible on the order flow. And of course, people are also using order flow to scalp. Now, I'm not a scalper. I do know how to scalp. I do know scalping techniques, so I think it's good to learn lots and lots of different trading techniques. One of the key things to keep in mind about scalping is that the trade location, context, correlated markets are key elements to scalping. So what scalping isn't, people aren't just switching on their trading PCs, seeing something on the bids and offers and hitting into the market, without considering the sort of overall activity in the market, as well as what might be in the menus, and any obvious hurdles in the market. Now there's two major components to order flow. One is actual, and that's what actually trades in the here and now, and one is intent, and the intent is really what people say they're going to trade. So of all the order flow tools, only the depth of market, and we'll show you the Jigsaw Auction Vista, only those tools show intent. So as a position day trader or longer term day trader, you can get away without using intent. Okay, so for many traders, the market depth itself is really not that important. Really not something you have to use. Now, as a scalper, that intent, the market depth, is more important to a scalper, but the actual executions are, the actual trades are still by far more important. So what the intent tells you is that people are interested in the level. So a lot of the time, the bids and offers are fake, or we call spoof orders, placed to make the market look weaker or stronger than it is, and that practice has been outlawed in the US futures market, but it's obviously not very easy to police, so effectively it's not really outlawed. But the fact is that if you see bids and offers really high in an area, it does not mean the area will hold, but it does mean it's an area of interest to other traders. And it's worth noting that when the market gets into tight range, such as the summertime and Christmas periods, you might have to turn yourself into a scalper to some extent if you want to play that range. And then as you move into that style of trading, that intent does become more important at the extremes. Now, the use of the actual trade information is what people talk about when they use the term tape reading. And at the end of the day, what tape readers are trying to evaluate is right here, right now, what is going on? Where are other traders positioned? Did we just see a stop run? Is one side in pain and kind of likely to hold back? Is one side trying to aggressively trade into stops? Do we have one side dominant in terms of order size but not getting any price move for their efforts? Is there an imbalance in trade? These are all things that order flow gives us, but price charts don't. So price charts simply tell us where we traded. Order flow tells us how we traded it, and also who is likely to be in position and what reactions might be imminent. Now, in terms of perspectives, when we look at price action, we have lots of traders that look at higher time frame and lower time frame charts. Might start with a daily, a 4-hour, and then all the way down to a 1-minute chart. With order flow, it's actually different tools that give you a different perspective on the order flow. So for me, I use cumulative delta very much on the S&P 500 to set bias, but I would never ever use that to enter the market. So you can put the different order flows, footprint, cumulative delta, on any time frame chart, but it's the way they actually present the information that gives them their own unique perspective. Now, when we talk about order flow, we've got to, we're looking at order flow, and some of it is probably counterintuitive, especially the old every buy is a sell thing. We have to understand first why price moves, and that might seem like a silly thing to say, why does price move? But it is key to understanding order flow. Now, different people are going to have different answers to the question, why does price move? Now, what I don't mean by why does price move, I don't mean why are people buying here? That's a completely different question. I mean, why does price move around? Now, some people will say, okay, price moved up because there's more buyers than sellers, but the number of buyers in the futures markets is always equal to the number of sellers. So the function of the market is purely to match buyers and sellers, and the trade can't take place unless you have both. So in a way, this could have you thinking that order flow is complete nonsense, because why analyze the flow of orders when every buy is also a sell? Because, one really cancels out the other, right? Now, another answer to the question, a lot of people would say supply and demand, and maybe that's close to the truth, but certainly not in the traditional sense, the traditional, hard goods sense. With stocks, you can have a situation where scarcity or lack of shares can drive up prices, but with futures, there is effectively an infinite supply of futures contracts. Okay, they simply get created as necessary when trades occur between two parties. Now, another answer might be, more aggressive buyers and sellers, and that's probably closer to the truth as I see it, or I like to see it as more as less patient buyers and sellers. But perhaps a better question, or another way to look at this, is maybe we should ask ourselves what stops price from moving, or why is it the S&P 500 futures doesn't trade at 2100 1 second, and then 2200 the next second, then 1200 the next, and then 5000 the next. It doesn't move around like that. It moves in an orderly fashion. And the answer to that question, why does price move, or how does price move, is also the key to reading order flow. And liquidity is that key to why price moves, or rather, the consumption of liquidity. So first let's talk about what liquidity is. It's the opposite of volatility for a start, which always confused me because liquidity and volatility kind of sound the same to me. But more liquidity means less volatility and vice versa. And liquidity is simply the availability of the other side to trade with. So if you want to buy, you need a seller to sell to you. And the market itself doesn't sell you shares or contracts. It just matches buyers with sellers. So when you trade, you're either providing or consuming liquidity depending on your order type. So if you buy at the market, then you buy from a liquidity provider on the sell side, which is somebody with a sell limit order. And if you sell at the market, you sell to a liquidity provider on the buy side, a buy limit order. So liquidity is limit orders, it's bids and offers, and for a lot of people it's kind of their eyes starting to glaze over when we start to use all this terminology to explain how it works. So let's kind of avoid the terminology for now, and let's just talk about floors and ceiling. So here we have a building. It was designed by me, hence it's got no stairs and no elevator. So let's just imagine for a second this is the market. Okay, so here we are, we're on the top floor. We've got a ceiling above us and a floor below us, which is kind of normal in all buildings. To move down to the floor below, what is it we need to do? Okay, well, we're going to need to break through the floor below us. Okay, and the market does exactly the same thing. Okay, the floors and the ceilings are limit orders, and these limit orders need to be consumed or eaten by market orders before we can move through the level. Okay, so to move down, we need to eat through the floor, and to move up, we need to eat through the ceiling. Now, at this point, we've just moved down, we've just eaten through a floor, so sell market orders have eaten the buy limit orders and we've dropped down. Think about it, at this point, is it easier for us to move down or up? Okay, and the answer is, it is now easier for us to move up, because this ceiling that's now above us, it was the floor, it's now the ceiling above us, it has a hole in it. Okay, there is nothing to eat above us and there is something to eat below, so obviously it's going to take more energy to consume this floor below us than to move up through the ceiling above us. And this is important. Okay, now the ceiling's been repaired, so now it's no easier to go one way or the other. Okay, and this happens basically all the way down. Okay, so think about floors and ceilings. Now in the market, here is your liquidity. Okay, so here are the floors and ceilings. Okay, so we can see, just make sure you can see my pointer. Okay, so we have the bids on the left hand side and we have the offers on the right hand side. Now some people say ask instead of offer, some people say resting orders instead of limit orders, some people use the term passive orders, all the same thing. We try and avoid the terminology if we can. Now it's worth noting at this point that markets don't have a current price. Okay, when you look at a market, you look at a chart, you're actually seeing the last price it traded, but at any one time the market always has a buy price and a sell price. So in this image, if you want to buy at the market, you'd pay 20.73. If you want to sell at the market, you'd pay 72.75. Probably not really any great revelation there. Now despite a lot of these resting orders being fake, we still have to move through them. Okay, so if we look at the blue numbers here, the blue numbers over here, we can see that it took 17 contracts, then 95 contracts, then 10, 64, 25, 1 contracts to move up through the offers. So that's an indication of how much depth was actually real. So that's how order flow lets us know the difference between the intent and the actual. So we've got the intent over on the right, what they're displaying, and then what it actually took to get through that. Okay, we're going to go on to the practical information, how to use that shortly, but just let's make sure we got the concept first. Because the other thing that's important to understand, we know where the bids and offers are, but there's a lot more bids and offers than you can actually see. So on the buy side, you might see 10, 5, 20 levels, depending on your platform. There is liquidity below that. There is liquidity below what you can see. But your platform doesn't display it. Your platform doesn't need to display it. It doesn't really matter how much liquidity there is 100 prices below. But there is no buy-side liquidity above the current price, okay? And, simple analogy, you've never looked up and seen a floor, okay? It's the same thing in the market. On the sell side, there are ceilings all the way up here. There's liquidity up there, but you just can't see it. Doesn't mean it's not there. But there is no seller liquidity below the current price. And that's really important because it means that as you're moving up into areas where no floors exist, but where ceilings do exist. And when you move down, you're moving down into areas where no ceilings exist, but where the floors do exist. And that means that, when you have a move up, you get a relative liquidity vacuum created beneath you. So it takes time for those floors to kind of build or be repaired in the wake of a move. And this is, again, we're going to see why this is really important in a minute, because spotting these liquidity vacuums where price pulls back, because of a lack of liquidity and not because of counter-trend trading, does represent one of the best opportunities in trading that a lot of traders really aren't aware of. Now, another way to look at this liquidity picture is quite simply that bids get thinner as we move up and offers get thinner as we move down, which brings us to another important point. If you get to an area of resistance, or an area that a lot of people think is resistance, the ceilings above you are going to be really, really thick. So you can expect the offers at, if you're coming back to the high of the day, for instance, you can expect the offers to be 1.5 to 3 times the bids. In fact, if you're not really sure whether a level you're looking at is one that a lot of other traders are looking at as resistance, this alone will tell you. So as you get to resistance, the offers will be stacked at that level, but the thing is, that does not mean the level will hold. And it's the same at lows with support. The bids will be stacked at any valid support level, but again, it does not mean the level will hold. And that's just one of the it's just the nature of the market. So, very often as price trades towards those thick floors and ceilings, they actually just pull out of the way. But it's a good indication if you're trading and you're setting levels in any particular way, and when you get to those levels, you don't see any anomaly in the bids and offers, it probably means it's just you. And to be honest, when you're trading, you really want to pick levels. To pick good levels, you actually need levels that lots of people are looking at, because that's where the market's going to react. So anyway, that's the end of the theory part, and we're going to see how this all fits together in practice. Let's just have a recap. So at any time the market doesn't have a price, it has a floor price and a ceiling price, which is also the inside bid and offer, with a minimum of 1 tick difference between them, and that difference is known as a bid-offer spread. Market orders consume buy-side and sell-side liquidity, also known as limit orders, also known as floors and ceilings. And when there's no more ceilings to eat, more buy market orders will start eating the next ceiling up, and price moves up with it. And all order flow analysis is simply a variation on that thing. Okay? As you move up, a relative liquidity vacuum builds behind you, and price momentarily collapses into those vacuums before continuing up. And those vacuums present short-term trading opportunities. Now, different players in the market work on different time horizons, taking different amounts of time to react and to fill those vacuums. And the fastest ones at reacting are obviously the HFT market makers. So what we see is, as these vacuums get filled in, it kind of creates lines in the sand in the form of higher volume areas that build up behind the move, and that's often what supports price as we move up. Now, you should always have your eye in the rearview mirror when you're using order flow, so don't just look ahead for obstacles, look behind you for volume areas, vacuums, because those are the things that are going to give you lines in the sand and prices to lean on. Okay, so what? So we know what order flow is. We've got an idea of the theory. We've got an idea, okay, so it's going to work in a certain way, but so what? Because so far this is just theory. How do you actually put this to action? What's even the benefit of understanding that liquidity consumption model? Okay, so let's consider the implications of what we've gone through so far in terms of things we regularly see in the market. So the first one is spikes versus churns, and okay, that's definitely some peak terminology. So a spike, by a spike I mean a rapid move up in the market, and a churn meaning a slow grind up. So lots of traders will see a fast move up in the market and they will think that that is a strong market. Okay, but if you consider the liquidity consumption model, you understand that a rapid spike up in the market is going to create a bigger vacuum behind it. Okay, so it's a rapid spike up is going to leave a lot of unfilled ceilings, unfilled floors behind it, and that is actually a sign of weakness. Okay, it's a sign that the market's going to actually be able to fall back much easier. On the other hand, if you've got a market that just grinds up all day, you could be watching that market and just watching it kind of tick up, 10 minutes and then tick up, and then 10 minutes and tick up. And you look at that and it looks weak. It looks like it really doesn't have any energy behind it. But that grinding action is actually a sign of strength, because that slower move doesn't have the same kind of size liquidity vacuums behind it. It's because it's moving more slowly. There's time behind the move for the liquidity to fill back in. So that's actually a sign of strength. So with less vacuums, you also have less reversal traders jumping on pullbacks thinking they're reversals. Because what happens a lot of time when you get the vacuum, people see the market pull back into the vacuum, and if that vacuum is quite deep and it pulls back quite deeply, you actually get reversal traders start to jump on that, which when the market grinds up, you don't tend to see. So grinding moves are obviously signs that market likes trading at successively higher prices. So we've all seen markets grind up. You're watching the market grind up, you're thinking, I've missed the move, you're waiting for a pullback never happens, and it makes those grinding moves hard to trade because we think that they're weak. We think we need to wait for a pullback, but if you see the grinding move as strength, it makes it somewhat more psychologically acceptable to actually jump in and start to participate, maybe with a small position, and then build that as the move continues. Now, retracements or pullbacks can be spotted by a lack of participation in a counter-trend move. So a market might move down in an uptrend, but if it's because of a lack of liquidity below, then the volume, the cumulative delta, is effectively, it's going to stay quite flat as the market pulls back. And what you tend to see, again counterintuitive, you might see a market make a with trend move of 15 ticks and 100,000 contracts, and then it might pull back 7 ticks on 20,000 contracts, and you think, you kind of intuitively think, well, that's weak. The market moved a lot of ticks on not a lot of trading, and to me, that is actually a sign that the market's actually going to carry on up. That the pullback is on low volume. It's just a lack of liquidity. And part of the reason that markets have a tendency to step up is that it takes time for liquidity to fill in the wake of a move. Now, you will always get these traders called perma-faders who can't stop themselves from selling every move up and buying every move down. So, you're always going to get some counter-trend participation because people just love to trade against a trend. In terms of the end of a move, well, most days are driven by intraday speculation. So for these daytime buyers, day traders, once they're in position, they have to actually get out of the market. So as you move up on a day, you're gathering sellers. Okay, sure, you're moving up because people are buying, but they all need to unwind intraday, or a large proportion of them do. And you often get to a point where you just need to offload some of these sellers before the market can continue up. So, sometimes that in itself is enough to trigger reversal. Sometimes it's just a pullback. Now, one of the things we should consider, because it's a big topic at the moment, all this HFT algorithms that everybody seems to be scared of, is the impact of participation. So, we've got liquidity, we've got market orders that consume that liquidity. Order flow is all about that process of liquidity consumption, but whose order flow are we actually looking at, and how important is it to know that? Because there's a lot of different types of participants in the market, and they all impact the market in their own way. Now, what we're going to cover now is going to sound somewhat counterintuitive, and I will simplify this a little bit because you could have a 10-hour debate discussing the nuances of this, but you would still in the end come to the same conclusion, which is that the higher the trading frequency, the lower the impact on the market. Okay, and this is important because participation changes from day to day. There's not many days where long-term institutional repositioning is really driving the market, and in my experience, less than 1 in 10 days. Yet these traders, the investors, the funds, they have a massive impact on price, often generating, complete one-way days. On the other hand, if you look at the kind of highest discount rates on the CME for markets like the S&P 500 futures, the highest discount rate is for trades that trade 135 contracts or more per day. So that's kind of the HFT guys. Yet those high-frequency traders actually have the lowest impact on price if you exclude the sort of hiccups caused by the occasional flash crash. And why is that? Well, an HFT is going to buy contracts and then quickly sell them. So any impact, excuse me, so any impact their buying has is kind of negated by the fact they're immediately going to turn around and sell it. So if anything, the HFTs make prices less volatile by the liquidity they provide. They kind of act as the market stabilizers. But a large fund initiating major repositioning or hedging is going to be trading in one direction. Remember, I'm simplifying things here because you can argue that, yeah, if you've got a bunch of contracts to buy, you might end up buying and selling intraday. And they're going to hold those contracts for months, possibly years. So on a day where you have that kind of major repositioning occurring, you might see that buying occurring for hours. You might see it happening all morning to kind of achieve the adjustments in position they want. It could even be doing it over days or weeks, but in all that time, their trading is going to be predominantly one-sided. And if you're only buying and you're buying a lot, then that's going to impact the market a lot more than somebody that buys and sells an equal amount. Now, swing traders have shorter holding times, usually days and weeks, and then obviously we get to the day traders. Position day traders are the guys that, holding positions for hours. So we call those, people have different names for that. Trying to take advantage of major intraday swings, staying in a position for hours or for most of the day. Scalpers are generally in and out of the market just looking for a few ticks. And then HFTs are mostly short-term market-making arbitrage trades. And you may notice on the majority of days, most markets put in decent-sized swings in both directions. But did you ever think about why that actually happens? I mean, it doesn't matter what you do. When I do pre-market prep for the S&P 500 every day, and where the market's going to go, but I know what it's going to do every day. It's going to go up and down and up and down. Okay, but why does it do that? So was it because a fund manager at Fidelity, woke up in the morning thinking, wow, the economy is really great, but at lunchtime he had second thoughts and said, oh my God, it's really gloomy. Is market sentiment really changing multiple times a day? Well, it's probably not, is it? What's really going on is that speculation is pushing the market in one direction, but as we said earlier, when a market's moving up, speculators will eventually have to sell to take profits. And in addition, when a market's moving up, at some point, traders will have built positions, to the maximum size they're comfortable with, and just won't want to add any more contracts. So you effectively run out of short-term speculators initiating new positions. The market slows down as we run out of buyers. Then, the people holding the long position see this, start to think about taking profits. They see the slowdown. They sell and the market starts to move down. People with no position or other people with long positions, maybe see opportunity to the short side now, and that move sort of snowballs downwards. So that cycle repeats itself over and over as the market swings up and down. And it's a cycle that a lot of small traders are trying to take advantage of, even though they don't really think too deeply about what's actually going on. And we have days where the volume increases, big boys are obviously playing the market, we get that larger institutional repositioning. And on those days, it's not short-term speculators dominating the market, and the market does behave differently. And the short-term speculators behave differently as well. And this is important because as a trader, it is the actions of the people in the time frame similar to you and above that will have the most impact on your trade. So right now, lots of traders are focused, trying to imagine what's going on with HFTs, that they lose sight of the fact that those are actually low impact traders. It's much more important on any given day to know if large institutional volume is driving the market, and that's not very difficult because if you look at today, look at how many contracts traded. Okay, it's really just about overall volume. It's important to know if short-term speculators are driving the market, or it's also important to know if you've got a low participation day where overall uncertainty, is keeping both short-term speculators and the big guys out of the market. And then there are times when the HFTs themselves disappear. You see times when the VIX index spikes, liquidity decreases massively, and we get big spikes in volatility. And what happens is basically some of the HFTs are pulling out of the way because they just feel the market's a bit too risky. So you've got to consider these things. Who's trading today, and it's not very complicated to figure out who's trading today. You've got to figure out who's participating in the market today, because that's going to affect your strategy. But of course, new traders would love to just be able to pull up a 1-minute chart, slap on a couple of indicators, and trade off it without worrying about some of these details. But this detail is the market, right? And it is key to understanding how the market's going to move that day. So following participation, in terms of increase and decrease in volume, as well as having an eye on the news that could be the trigger for this change in volume, it's not particularly difficult. Neither is keeping your eye on the depth of market to look out for big shifts in terms of the liquidity amount. But it is absolutely a benefit to your trading. So price charts are going to tell you where we traded, but they're not going to tell you about that kind of shifting state of participation in the market. Okay, so we've got a feel for the theory of order flow. Let's have a think about the implication of this when it comes to reversals. And when I talk about reversals, I'm talking about major reversals, so an intraday high or low of the day kind of reversal, and minor reversals, the pullbacks. Now, based on what we know about liquidity and liquidity being consumed, we can identify 3 elements that will cause a reversal. Okay, just 3. Now, not all reversals have all 3 elements, but all reversals have 1 or more of them. And the market can only reverse with these three elements, and without them, it's not possible for the market to reverse. Okay. Now, some of these elements are easier to spot in the order flow than others, so let's consider them one by one. And for the sake of simplicity, let's just consider I'm talking about a long to short reversal, and just presume it's the same the other way around. Okay, so the first thing that we look at is absorption. And absorption is where buying continues, but the ceilings don't break. So the ceiling will either just be too thick, or as the buying starts to eat into that ceiling, we see more limit orders come in and see that ceiling built back up before it can be consumed. And that rebuilding the ceiling as it's being consumed is what we know as an iceberg order. Now, in terms of being easy to spot, this is by far the easiest thing to see. Yeah, we can show you this, and within 5 minutes, you'll be able to spot it. And absorption takes place over actually a decent amount of time. So on thicker markets, it can actually take many minutes. And what it means is the offers, the ceilings, the sellers are stepping up and absorbing all the buying. So buying is no longer able to move the market up, and eventually the buyers are going to give up or run out of money. And in some cases, you're going to be able to join the offers, but that really depends on the market. So on the treasuries, joining the offer is often possible. On the S&P 500, joining the offers generally leaves you without a fill, certainly on the trades that are going to work out. The second thing that we will see, second element of reversal, is buyers fading away. And this is where we get to a price and just nobody wants to buy anymore. So sometimes that's a gradual change. So you might see 1,000 contracts trade, then you tick up. At the next price you trade 600, we move up. Next price 300, and we move up. Next price 45 trade, and we're done. Other times you kind of have regular trading at one price, then you tick up, and there's just literally nobody there. And ultra thick markets like the treasuries will tend to hit just one price like this, and often the treasuries are going to hit this price once. Markets like the S&P 500 crude tend to go to a level a few times, okay, and test it a few times, and each time either none or very small amount of contracts trade, and that's fairly easy to spot, but it does take a bit of practice, and quite often you don't have the luxury of time to react as you do with the absorption. Now also you've got to remember that markets do pause. So when you're looking for this kind of activity, you need to be looking for this activity at a key level, at a sensible price. And there's also time element to this. It does take time for the buyers to realize nobody's buying anymore, and then they start to unwind, and then you see sellers coming in. And that sellers coming in is the third element of reversal. We call it the market rolling over. And this is where you don't so much see the buyers fade away as you just get to a level, and then suddenly the sellers start hitting aggressively with size. And many times this will be after the absorption or after buyers fading out, but often it'll just come out of the blue with no warning. Now, you'll most likely see sell market orders be roughly 2-3 times the quantity of buy market orders when the market rolls over. And it is hard to spot in a timely manner. In other words, by the time you spot it, the market's going to move down a few ticks. And at that point, you can decide to get in at a worse price, but with more confirmation, effectively, trading a good price for certainty, or you can pass on the trade, okay? But just bear in mind that, when you see the sellers come in, that's actually confirming the trade for you, and that doesn't make it a poorer trade, just makes it a slightly different way to approach the market. Of course, this seller stepping in is going to help you confirm a trade after the event, because there's no law with order flow that says you can only use it for order entry. It is an excellent way to confirm that a trade is actually going your way and that you should hold on to it. Similarly, it's a good way to tell that the order flow is against you and that you should actually get out of a trade. Now, just to reiterate, these elements of a reversal are not mutually exclusive, and you will see one or more of them with any reversal. So let's look at the reversal on the E-mini S&P 500. So this is the Jigsaw tools running on the Zena 360 platform. On the left, we have the Auction Vista chart. Just quickly go over what that's showing you. The yellow lines show us where we've traded. The offers are above us in red. The larger offers in lighter colors, and the bids are below us in blue, with the lighter colors being the larger bids. Then we have these circles that show us where exceptional size is trading over time. On the right over here, we can see something called the Jigsaw depth and sales. Not going to go over all the columns, but we can see the bids here, offers here, and between that, we can see how many market orders have traded into those bids and the offers just this time round. So if we move away, come back, it's going to clear that information. On the far right, we have something called a reconstructed tape. That's showing orders of 50 contracts and above. And up here, we have a meter showing sell market orders in red versus buy market orders in blue. Now, the volume profile, looking at this, shows us that so far the market's pretty balanced. This is obviously very close to the open. It's a low volume start to the day. We're actually in a low participation area overall. The market was overall showing a lack of conviction at this time. Now, we came down to 21.10.25, and we can see a massive amount of trade. If we look over on the right, we've actually got over 5,000 contracts traded at that price, and we couldn't move through. Now, we can also see a large trade circle on the Vista chart here, which shows how, there is size trading at that level. And we can also see that circle is much larger than any of the circles we've seen elsewhere, and obviously that's because there's more volume there than we've traded anywhere else. Now, as this is a low volume market, you're going to expect range-bound behavior. Remember, I told you before, the participation really does matter. So if you have if you've got a few days where the volume's really low and you open again and the volume's low again, you're going to expect a range day. And there's no magic to that. It's just a matter of just keeping your eye on the overall volume and activity. You can't just say, I'm always going to trade like this. So on a day like this, you've got low participation. We're not expecting much. So contextually, we'd already be looking, we're coming back towards the low. We'd already be looking for the market to hold, at the bottom of the range. But as it is, we didn't actually get to anywhere near the low of the day. And this is an example of expecting a reversal in an area, but it reversing earlier than we expected. Now, we're at the lower value for the day, so we can see this orange area is actually the developing value areas, and market auction theory tells us that value is where 70% of the volume traded. It's a simplification, but again, the extremes of value are areas where people do look to initiate trade. Now, with all of these trades here, all of this volume here, it means we're going to have a lot of people positioned in this location, okay? Many of those are going to be short-term traders. There's no indication that this is a day where there's a lot of long-term institutional repositioning. Now, as we move away from this area, whether we go up or down, traders on one side are going to exit their position. We're going to have some of these guys stopped out because every buy is a sell. We have a lot of positions here. As we move away, one side's going to get stopped out. And that's effectively what we're going to try and take advantage of. We're looking for a long off the bottom anyway. If we move up, the shorts are going to have to buy to exit their positions, and we want to take advantage of that, as I say. Now, if we buy here, we stand to get a decent pop-up for this kind of day if the market moves our way. On the other hand, we don't actually need to allow a trade here, a big stop, if it starts to move against us. Okay, so we're leaning on all of this volume traded here. If it moves like 3 or 4 ticks below, we know that our premise for the trade is wrong. So our premise for a trade here would be, these guys, there's a lot of people positioned here. We think the shorts are going to get stopped out because we're at the lower value. So we can take a trade here. If it moves against a few ticks, we get out. Potentially we've got a target of the the high of the day, and potentially we might leave a few contracts on to kind of see if we get an extension through the top. So one of the things about a trade like this, or an area like this, it's actually giving you a good risk-reward ratio. So you don't need a trade. If you're leaning on volume like this, you don't need to be right all the time. You don't need to be right 50% of the time, but you do know that once this starts to break down, once this volume, we start to move through this volume to the downside, that these guys are going to get stopped out. Okay, now we entered a trade at 10.50. Now remember, it's a low volume, low range day. We're not looking for a 10-point trade on a day like this. We're using the lack of participation to judge the state of the market and deciding it's probably not going to be a big range. So let's take a look at what we can see now. So we can see, looking at the current trades, which has been reset, we didn't trade below that circle, okay, that area of high volume. It held there. We can see from the way the angle of ascent here that we got a nice little pop-up, and that's just indicative of short-term traders being stopped out. So when you see a stop run, it's something that happens quite quickly. Doesn't mean it's going to move 100 ticks. Stop run the S&P 500 is usually like 5 or 6 ticks, something like that. And we can see the size of the trades executed on the buy side is actually much larger than on the sell side, and we can see the meter here, which resets when we actually enter the trade, is imbalanced about 2.5 to 1, and that's typical of a strong push up to see the buyers outnumber sellers 2 to 1. And we can also see on the tape, on the large side, it's mostly buyers. So this is a reversal where we had absorption, and then we saw the buyers step in, some because of stops, some because of what I did, started buying when they saw the trap. Now this is not really trading a pattern. This is trading with, some kind of knowledge of other people's positions, understanding the market level of participation on the day, and really knowing where you're wrong and where you're right. Now here's a good example on crude oil. First thing we're going to notice here is the size, okay? We have a large trade circle here, but there's only 146 sells versus 233 buys, and that's much smaller than the 5,000 contracts we saw in the previous example. So crude is a much lower liquidity market, so seeing 100 or 200 contracts on crude at a level is kind of effectively the same as seeing a couple of thousand on the S&P at the level. So once again, we see absorption, and then we see buyers come into the market. Now this area of absorption then becomes something we call a hidden backstop. So that's an area which is significant from an order flow perspective, but might not be significant from a price action perspective. So we can see where we got that absorption, we came back, couldn't get through it, came back a second time, couldn't get through it. So we have 2 moves down to that price, and in both cases the sellers faded away. They just didn't want to sell at those prices. Now why would that be? So why would sellers not want to engage down here? Well, if you think of this circle as an area where both buyers and sellers initiated new positions, the sellers there lost money and the buyers are quite happy. So when you return to that price, it's only natural for the sellers to feel uncomfortable selling where they or other sellers just lost money. A good analogy for it perhaps is, you go to the races, you put money on a horse, the horse finishes dead last, horse is in the next race, and I know they don't run 2 races. You don't put money on the horse, the same horse again that you just lost money on. And that's effectively what happens in the market. You see, as you come back to these areas, you just see an unwillingness in speculators to kind of sell that area again. Okay, and so that's why we lean on these high volume areas, because those areas are the places where we know the most sellers will be a bit shy. Now we can also see buyer liquidity below us, builds below the market as soon as we come down. So we come down, we trade there, and we get all this buyer liquidity. And again, that's something, it's not something you would trade off, but it's a part of the story, and that will, again, help to put people off selling down towards that area. Now, this could just be, these bids here could be market makers, could be some opportunities traders, putting bids in, just to, on the off chance, I'll get some good prices. Now, if you look at the other liquidity around here, as we move up, we can see really around this price all the way up, we've got this kind of much lighter areas in the bids and offers, and that's most likely just HFT market makers activity, trying to pick off bad traders or play the spread. So if you think about it, on the way up, smart traders should be buying. So if somebody sells to a market maker, it's actually quite a low risk trade for that market maker, and probably a bit of a silly trade for the seller. So you tend to see, as we put in a move up, you tend to see bidders following that move up. Now that's the basics of order flow, okay? Fairly simple, and the process of reversals, and a couple of examples, showing the reversal. So remember, the goal here wasn't to make you an expert in all aspects of order flow, but to give you a concept, an understanding of the concept of liquidity consumption, participation, and the process of reversals. And that brings us to the close. So actually a good time to type in questions as I finish out. Now reading order flow, it's not mechanical, excuse me. It requires the use of discretion. So it's a bit like reading a story. It doesn't mean you trade without rules. It just means that every situation is different, but the overall patterns, the overall behavior is recognizable with practice. And it also doesn't mean it's particularly difficult. There's a lot of people that want to trade mechanically, to have a fixed set of rules because they kind of think that's easier, but they then spend 10 years playing with indicator combinations trying to find that fixed set of rules. So don't be scared of using a bit of discretion in trading. It's what a lot of professional traders do, and it's no different from using discretion in other things in life, like driving, for instance. In terms of the tools you saw today, they are part of the Jigsaw trading tool set. We've got over 3,000 users on those, and they do work as a plugin to the Zania 360 platform. Now, we didn't show all the features of the tools today. The focus was really to lay the groundwork for understanding the benefits of order flow and to show a couple of practical examples. It's the understanding of that theory that is most important. With that, you can really progress with practical, application of order flow on any order flow tool. Now, there's a lot more information about this on the Jigsaw Trading website. We've actually got over 10 hours now of free training material with a lot more in-depth information on order flow, using it for trade management, using it for scalping, stuff on volume profile analysis, intermarket analysis, much, much more. For customers of Jigsaw, we have a free active chat room that's open daily where traders come and chat. I personally take time to chat one-on-one with the customers as well, and we try and bring people together in that chat room so that customers can meet other customers. Now, I was lucky enough when I started as a trader to have help from a number of professional traders who are really generous with their time and information, and that really helped me. So I believe in bringing traders together, partly to discuss the use of the tools, but just also to just share information and improve as a group. And it helps with confidence too, because we know that a lot of vendors actually kind of want to prevent their customers from talking to each other, but when you can go into a chat room where real traders are using the same tools as you each day and they're quite happy to discuss them, it kind of gives you confidence to stick with the learning process, because you can see other people that have been through that learning process and are reaping the benefits. And we also have an active community of traders. There's a lot of blogs, YouTube pages out there explaining how people use the tools. The tools themselves, they cost $399.99 for a lifetime license. We have a 14-day money-back guarantee. The terms of the guarantee are basically, if you don't like it, just ask for your money back. There's no reason to tell us why. It's not for everybody, order flow. So basically, we don't want to be selling tools to people who then, decide that order flow is not to them. Now, whether you are or aren't incorporating order flow into your trading right now, we do have the leading order flow tools on the market for a reason. They really help to improve your trading, and we do our best at Jigsaw to ensure you get help you need along the way so that you actually get those benefits too. Anyway, Carley, I can't see the questions, so could you field the questions for me?
Yeah, sure, not a problem, Pete. Does anybody have any questions? Looks like you must have done a very good job. Not a lot of questions. In fact, no questions coming in so far.
Okay, that's fantastic.
Yeah, good news.
Go back to bed.
All right. All right, well, we appreciate you coming today, and if anyone does think of a question afterwards, Pete's email address is right there, or you can always send it to us and we'll forward it on to him. But we appreciate you coming, Pete. It was great. I learned a lot. This is definitely a different side of trading that most of our clients have been exposed to before, so I think it's going to be a great thing.
Thanks, Carley, and thanks for attending, people.